Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Mathew. One of the golden rules of personal finance is to have an asset allocation strategy. Now, you'll hear a lot of people tell you that you should go out and do this or that. And some of them might just have told you that equity is your best friend in your 20s and you should have most of your portfolio allocated towards equity. That's not really the way to go about it. In fact, there is a strong case to be made for asset allocation, and there are actually multiple ways in which you can choose to allocate your money towards these assets. And by these assets, I'm talking about equity, fixed income, gold, real estate even. So what are the various ways in which you can do this, and what is ideal for you? I'm joined today by Megha Malpani, who is a partner at Zvest Financial Services. Megha, thanks so much for taking the time. And let me ask you at the onset, should everyone have an asset allocation strategy that they're using?
Thank you, Alex, for having me here. And I think it's a very, very important topic to be addressed because to my mind, asset allocation is the foundation on which an investor's investment journey rests. Right. So, before any investor decides where to put in their money, I think, two important questions have to be honestly answered. One, can I afford this risk? And will I genuinely be able to stomach it if things go south? So one addresses the ability to take risk, which is an objective number and can be easily measured. It depends on factors like age, income stability, monthly surplus. Have you done your risk transfers already? Who are your financial dependents? These are all objective and can be measured. Second is willingness, and it is largely behavioral. And in my experience, I have often seen investors to get this wrong. Because in a bull market, we have a tendency to overstate our risk appetite, and in a bear market, we understate it. Daniel Kahneman clearly states this as a loss aversion bias, wherein, losses roughly feel twice as painful than equivalent gains, right? So it is very important to arrive at your willingness to take risk, through a structured discussion with your advisor. If you don't work with an advisor, you can do it through psychometric assessments. And then once you have established this, map your asset holding periods to your time horizon. It is important to understand that, equities are not really for 3 to 5 years. They are a decade phenomenon, if not multi-decadal phenomenon. And debt services, short-term needs. So the asset allocation frameworks that exist are basically just as a sanity check, but they cannot become a starting point for any investor.
Sure. Okay, so let's hope that people have bought into this idea, and now we're going to the next step. But just before we start, the big drawbacks of not having an asset allocation strategy, it's quite likely that you've got too much risk or not enough that you are taking, and so as a result of which you will either lose money and lose capital because you're over allocated towards an asset class that might not be relatively safe when you need it to be, and two, it's possible that you're under allocating towards that asset class, and conversely, you're not earning enough to beat inflation. Is that the long and short of it?
Absolutely.
Okay, so let's start with the first of many asset allocation strategies, which is the core and satellite. And we've discussed this as a separate topic on the show, but very quickly, how does this work?
So a core is anything which you can hold for long term. It is not typically determined basis your risk levels, but it is determined basis, what your holding period could be. Now, for different investors, at different, time frames of their investment journey, it could range anywhere between 75 to 85%. As you rightly called out the asset classes, equities, fixed income, gold, international equities, real estate, all of it form a part of the core portfolio, which you decide to hold long term. Satellite is something wherein, for different investors, it can be taking different risks in the portfolio, right? But it is also very important to understand that, while you are taking a satellite approach in the portfolio, you should very well define what your exit points would be, and it should not be on the basis of a FOMO, right? Now, what are the products that fit into this list? It could be PMS, it could be an AIF, it could be private credit, SIFs now, etc. But it is important important to analyze the returns of these strategies at a net level. Gross level, they look very glamorous in marketing brochures, but we have seen that, if you look at these strategies on a post-tax, post-expense ratios, most of them underperform, core portfolios like an index fund or an actively managed mutual fund, right? It could also be, some part in the startup capital for ultra HNI investors. We have come across some new investors who want to probably, take a stab at cryptos and, also try to, do it through direct equity. But remember that only that part of the capital which you're okay to take risk and you will not have a problem if you have to hold it for longer and it doesn't work as per your plan, only that part of the portfolio can go into a satellite portfolio. But the deeper point that I would like to highlight here is it is absolutely okay to not have a satellite in the portfolio and it is often seen that, it is a right strategy because you don't need a PMS AIF or a startup to be a serious investor. You don't have to validate or prove yourself to anybody. You need clarity that you don't need to own it because everyone else is doing it.
That's a fair point. And also, I think to a certain extent, this helps people scratch that itch of saying, oh, you know what, I want to have that tactical allocation towards direct equity. I know the next stock that is going to do particularly well, or it feeds into my thesis. So I think this relates to those people. The second one is actually the 50-30-20 framework. And I've had quite a few conversations about this specific framework in the recent past, Megha. What's it about?
So what it states is that, 50% goes into equities and equity-linked instruments, 30% into fixed income, and 20% into alternatives. But, Alex, it is important to recognize that asset allocation doesn't work in a point allocation framework. It typically works in a range, right? So you say that, I'm okay to have 45 to 55% of equity. And how do you define at what range in the spectrum are you going to be? That is purely a function of where the valuations are. If we were talking somewhere, 3-4 months back when Nifty was trading at 20 to 24 times the multiple, it made sense to probably be on the lower side of your equity range. But as we speak where, some amount of froth has been, kind of done away with, it makes sense to increase your equity allocation. Now, I feel this strategy is very individual specific. Say, I'll give you a case in point where it doesn't work. For minors, for example, because for a minor who's starting his investment journey earlier, he has no reason to be into fixed income or, into alternatives unless, his education needs are just 2 or 3 years down the line. The best fixed income strategy, he or she can take exposure to could be, a public provident fund or a Sukanya Samriddhi Yojana if it's a girl child. Alternatively, if you are somebody where your corpus itself is not large enough, where, you're taking a 20% exposure into alternatives becomes a concentration risk in the portfolio, then it might be prudent to wait till you reach a certain threshold of the portfolio. Also one important thing, it is very important to highlight here that fixed income is for resilience and it is not a risk maximizing strategy. People do not understand the difference between a AAA rated portfolio versus a credit risk portfolio. So ideally, where do you place this is also very important to understand. I think, for alternatives, I think SEBI has done a good way to democratize this whole thing by introducing SIFs. But it is important to also highlight here that, it is something which is very new, not tested and tried. We do not know if we have enough long short fund managers in the industry. It will be prudent to wait for such time to, see how these strategies are performing. But yes, alternatives could be, taken exposure to through SIFs once, they kind of prove their merit.
Some very important takeaways from that, Megha, and I think a very strong point that you're making on fixed income, which is it's meant for capital preservation rather than capital or profit maximization, and to the point on SIFs. But just a quick follow-up here, you can consider gold, you can consider REITs, you can consider InvITs as part of that entire alternatives bucket.
Absolutely. They should be a part of the portfolio. I mean, as I said, they are the core of the portfolio.
Sure.
But it is important to understand that, 20% of your portfolio just in an AIF is a huge concentration
Sure.
risk. But 20% split between different alternatives is a good
Makes sense.
structure to have in the portfolio.
Yeah, I was reading online, and this is another asset allocation strategy. It's been attributed to Ray Dalio, and it's also called the all-weather portfolio. How does it work?
Yeah, so let's understand where does this stem from, right? Now, if you're looking at a 60-40 portfolio, what you're technically doing is you're just diversifying the capital, but you're still holding concentrated risk because equities inherently are thrice as risky as fixed income. Now, why was this strategy designed? It was designed to kind of overcome all seasons, which was predominantly rising growth, falling growth, rising inflation, and falling inflation. And to combat all of this, what he proposed was 30% in equities, 40% in long bonds, 15% in intermediate bonds, and 15% in gold and commodities. But let's go back and see what this strategy has done. For the last 10 years, in dollar terms, this strategy has delivered a 3.6% CAGR versus S&P, which has done about a 10 to 12 odd percent CAGR. Of course, in the 2008 global financial crisis, this strategy performed. But look what happened in 2022, because this structure was built on the assumption that interest rates are always going to be falling. This strategy had its worst possible year and gave a 18% negative CAGR. Right? So the point is that it works in certain macroeconomic situations for certain set of investors. I don't think in the Indian context it works because we do not have the kind of markets it is talking about. We can't trade in commodities. Our GSEC market is very, very thin. The only possible proxy that we have is gilt funds. We do not have a TIPS equivalent, in India to trade on. So I think, it is an operating system, but, we cannot just copy paste. We need to derive better applications out of this framework.
Okay. I haven't asked you about the age allocator because that's the most simplistic thing, and I'll come to that if we have the time. Tactical asset allocation, and this is the last one of the primary asset allocation strategies. How does this work?
Right. So let's understand what is strategic asset allocation and what is tactical asset allocation. Strategic asset allocation basically looks at your long-term target mix. It is set very deliberately. We advise to review it annually and not to react on it unnecessarily. But tactical asset allocation is basically a deliberate time-bound deviation based on a specific thesis about an undervalued asset. The premise of tactical asset allocation is that most assets revert to their long-term fair value just by the principle of mean reversion. When does this strategy work and when it fails? It works when you have been able to identify the strategy much before it becomes a consensus trade, and you're able to participate in it and write the entire re-rating curve. And it is prudent. It is equally important to understand when do you exit this strategy. If this strategy is done when you're a late entrant to the party, it can become a very, very expensive affair. Let's look at what happened in the Indian markets, right? 21-22, small caps had negative flows and they were going through a period of underperformance. But come late 23, at 30-35 times the multiples, small cap funds saw the maximum inflows, and the year 25 was followed by a 7% fall in the small cap space, and 1,000 stocks fell 50% from their all-time highs. The same trend was repeated in the year 2024 through thematic funds, and the same thing was again repeated in 2025, when only in the last half of the calendar year did we actually see positive inflows as far as gold and silver was concerned, when central banks in reality had stopped kind of buying gold to the same level they were buying in the previous years. So the point that I'm trying to highlight here is that it has to be done. It has to be identified very early on. And if you kind of take exposure there, it works in adding some bit of alpha into the portfolio. Now, another point I'd like to highlight here is if your strategic asset allocation says 60% into equities, through tactical asset allocation, your equities can just go up maybe to 65 to 70%. It can't become 90% because if you do that, you will damage the entire asset allocation that you have built for yourself.
Okay, just closing comments now. And Megha, the reason I didn't bring up that age allocator is because it's supposed to help people cut their teeth and maybe start with the process of asset allocation, right? It's a little more involved than that. But having said that, we've discussed a few pretty technical details of asset allocation. If somebody is looking to keep it simple, how should they go about it? Because in a sense, if you've decided on a certain asset allocation strategy, in this kind of a market where equity is going down very sharply, you can actually use that to correct imbalances, right? That's the basic premise of it. It prevents you from using your emotions when you're buying or selling things, right?
Right. I think why it is important is because every time you get tempted, biases, take over you, you get prone to taking ad hoc decisions. It's a document you can go back to and see what you should do and what you shouldn't do. I think it works more on the principle of a via negativa, where it tells you what you're not supposed to do because it doesn't work in your overall scheme of things. So to my mind, just understand yourself, your liquidity needs and time horizon needs, map your assets. And once you do that, do not unnecessarily touch it or, try to meddle with it too much, because most of the returns don't come from identifying the right asset, but it comes from not doing the wrong thing at the wrong time.
Got it. All right, Megha. On that note, thanks so much for taking the time. What I'll do is I'll invite my viewers to write to us if they want a specific topic within this overarching subject to be covered in more detail, and we'll do that going forward as well.